Inventory measurement is a critical aspect of financial reporting because inventory often represents one of the largest current assets for manufacturing, wholesale, and retail companies. The valuation of inventory directly affects cost of goods sold, gross profit, net income, working capital, and key financial ratios. The program emphasizes that analysts must understand inventory accounting methods and valuation principles because differences in inventory measurement can materially influence financial statement analysis and company comparisons. Inventory generally includes raw materials, work in process, and finished goods held for sale in the ordinary course of business. Accurate inventory measurement improves the reliability of financial reporting and helps investors assess operational efficiency, profitability, liquidity, and future cash flow generation more effectively. Inventory is initially measured at cost, which includes all expenditures necessary to bring inventory to its present location and condition. These costs typically include purchase price, transportation, handling, direct labor, and production overhead associated with manufacturing. Accounting standards require firms to allocate production costs systematically and consistently. The program explains that companies must distinguish between product costs, which are capitalized into inventory, and period costs, which are expensed immediately. Proper classification is essential because inventory costs remain on the balance sheet until goods are sold, at which point they become cost of goods sold on the income statement. Analysts carefully evaluate inventory accounting policies because they directly influence profitability and reported asset values. Several inventory cost flow assumptions are permitted under accounting standards, including specific identification, first in first out, FIFO, weighted average cost, and last in first out, LIFO, under US GAAP. FIFO assumes the earliest purchased inventory items are sold first, resulting in ending inventory values that more closely approximate current replacement costs. Weighted average cost assigns average inventory costs to units sold and remaining inventory. LIFO assumes the most recently acquired inventory is sold first, leading to higher cost of goods sold and lower ending inventory values during periods of rising prices. Because IFRS prohibits LIFO, analysts comparing international firms must understand how accounting differences affect profitability, taxes, and financial ratios. Inventory measurement significantly affects profitability and financial statement analysis, particularly during periods of changing prices. Under FIFO, during inflationary environments, older lower-cost inventory is recognized in cost of goods sold, resulting in lower expenses and higher gross profit margins. In contrast, LIFO produces higher cost of goods sold because more recent higher costs are matched against revenue. The program notes that compared to FIFO, LIFO generally results in lower gross operating income and lower ending inventory balances during inflation. These differences influence liquidity measures, profitability ratios, tax obligations, and asset turnover calculations. Analysts therefore adjust inventory figures when comparing firms using different accounting methods to improve comparability and analytical accuracy. Inventory must also be evaluated for impairment when its carrying value exceeds net realizable value or market value. Under both IFRS and US GAAP, inventory write-downs are required when inventory becomes obsolete, damaged, or difficult to sell. The write-down reduces both inventory on the balance sheet and profitability on the income statement. However, accounting treatment differs slightly between IFRS and US GAAP regarding reversals of inventory write-downs. IFRS permits reversals if inventory value subsequently recovers, while US GAAP generally prohibits reversals. Analysts examine inventory write-downs carefully because they may indicate declining demand, weak inventory management, technological obsolescence, or broader operational problems that could affect future earnings and cash flow performance. Inventory analysis also involves evaluating operational efficiency through inventory-related ratios and trends. Measures such as inventory turnover and days inventory outstanding help analysts assess how effectively a company manages inventory relative to sales activity. High inventory turnover generally indicates efficient inventory management and strong demand, while slow turnover may suggest excess inventory or declining sales. The program notes that rising finished goods inventory relative to sales may indicate weakening demand and reduced production efficiency. Analysts therefore combine inventory measurement analysis with profitability, liquidity, and operational metrics to evaluate overall business performance. A strong understanding of inventory accounting enables more accurate valuation, forecasting, and assessment of corporate financial health.